Today, we're going to explore a major yet largely underreported financial move by the Bank of Canada. In 2024, the bank injected $30 billion into the repo market, though temporary loans to the banking system. But what exactly does this mean? And why is it such a critical event for the Canada's financial system? Let's break it all down so that you understand not only what happened, but also why it matters to every Canadian. To understand the significance of the Bank of Canada's actions, we first need to understand what the repo market is. Repo, short for repurchase agreement, might sound complicated, but it's a simple financial transaction that helps maintain liquidity in the system, keeping the gears of the financial system well-oiled. Let's break down the step-by-step approach. At the end of the business day, banks and other financial institutions often find themselves needing cash to settle their transactions. Maybe they've lent out too much money during the day, or perhaps some payments they expected haven't come through yet. In any case, they need short-term liquidity. Here's where the repo market comes into play. Banks can borrow money from other financial institutions like pension funds or insurance companies using some of their assets, such as government bonds or high-quality mortgages as collateral. Collateral and short-term loan process. When a bank needs cash quickly, it can offer these assets as collateral in exchange for a short-term loan. The bank agrees to buy back or repurchase those assets at a later date, hence the name repurchase agreement. In return, the lender charges a small interest, known as the repo rate, for the privilege of borrowing that money. How big is the repo market? This process happens every day on a massive scale in Canada. The repo market typically involves $10 to $20 billion worth of transactions every day, with various financial institutions borrowing and lending money to meet their daily needs. The repo market helps the banks and financial institutions keep the operations running smoothly by ensuring they always have access to the short-term funds they need. It's important to note that the repo market is a key part of the financial system, not just in Canada, but globally. In the US, for example, the repo market sees trillions of dollars changing hands daily. Without it, the financial system would struggle to function effectively. The Bank of Canada's recent entry into the repo market, however, has raised eyebrows. It's not something the central bank does frequently, if at all. Typically, the repo market operates smoothly without intervention from the Bank of Canada. However, starting on January, the bank injected nearly $5 billion per day into the system, amounting to a total of $30 billion over a short period. Why did the Bank of Canada step in? This raises the question, why did the Bank of Canada feel the need to intervene so aggressively in a market that usually functions without issues? The answer lies in the growing signs of the stress within Canada's financial system. The fact that Bank of Canada had to step in suggests that some significant financial pressures has been building, causing liquidity to dry up in the repo market. By intervening, the bank ensures that the system continue to function by providing the necessary short-term loans that the banks and financial institutions need to keep going. While the exact reasons for the Bank of Canada's intervention remain somewhat opaque, financial experts have identified two kinds of causes: collateral valuation causes and a lack of liquidity. The first potential reason is related to the collateral that banks and financial institutions are offering in exchange for short-term loans. Typically, high-quality assets like government bonds are used as collateral in a repo market. However, if these assets are not being valued properly by the institutions that hold them, this can create problems. For instance, if the assets being offered by banks are perceived as risky or devalued, other financial institutions might be reluctant to lend against them. They may not feel confident that the collateral is worth the amount the borrower is asking for, which could lead to a liquidity crunch, where banks can't secure the loans they need. This type of problem has a major issue during the 2008 global financial crisis. Back then, many banks were holding assets, particularly mortgage-backed securities, that had lost significant value, When these banks tried to use those assets as collateral to secure loans, other financial institutions simply didn't trust the valuation of the collateral, which contributed to a widespread liquidity crisis. If you're enjoying this breakdown so far, please take a moment to hit the like button and drop a comment. I'd love to know what you think about the Bank of Canada's intervention. Do you think it's the right move? In Canada, there's no indication that the situation is as severe as it was in 2008, but only uncertainty about the value of collateral can still cause significant disruptions in the repo market. Reason number 2, the lack of liquidity. This second potential causes for the Bank of Canada's intervention is lacking of liquidity. In this system, when there isn't enough cash calculating within the financial system, it can drive up the repo rate. The repo rate, as I mentioned earlier, is an interest rate that the financial institutions charge each other for short-term loans. When liquidity is tight, lenders demand higher rates in exchange for their cash. This makes it more expensive for banks as well as financial institutions to borrow money, which can lead to further strains on the financial system. This is exactly what happened in the United States in September 2019, when the repo rate suddenly spiked, prompting the U.S. Federal Reserve to intervene by injecting billions of dollars into the system. In Canada, the Bank of Canada's intervention suggests that a similar situation might have been unfolding. By injecting $30 billion into the repo market, the bank helped to ensure the financial institutions had access to the cash they needed, by preventing a sharp increase in the repo rate and stabilizing the system. What does this mean for Canada's financial system? The Bank of Canada's intervention raises several important questions about the health of Canada's financial system. While the bank's actions have stabilized the repo market for now, the moves suggest that there may be underlying issues that need to be addressed. Is this a temporary problem or a sign of something bigger? One of the key questions to ask is whether there is simply a temporary liquidity issue or whether it's a sign of deeper and more symptomatic problems within the Canada's financial system. If the problem is temporary, then the Bank of Canada's intervention may be enough to restore normal function to the repo market. However, if the issue is more deeply rooted, such as concerns about the evaluation of the collateral or the borrower financial stress, the bank's actions could just be the beginning of a larger effort to stabilize the financial system. Is Canada's economy more vulnerable than we thought? The fact that the Bank of Canada had to step in at all suggests there may be vulnerabilities in Canada's financial system that aren't immediately apparent. Canada's banking system is often regarded as one of the most stable in the world, and the country has weathered past financial crises better than many others. But the need for such a significant intervention in the repo market indicates that things might not be as solid as they seem. Are we entering a cycle of quantitative easing and tightening? Another possibility is that Canada could be entering a cycle of quantitative easing or tightening, similar to what happened in the United States after the 2008 financial crisis. Quantitative easing is a process that central banks purchase assets such as government bonds to inject liquidity into the financial system. While this can help stabilize the economy during times of a crisis, it also creates a challenge when the central bank needs to pull back its support. If the Bank of Canada finds itself needing to intervene in the repo market for a regular basis, it could signal the beginning of a similar cycle in Canada, which could lead to periods of financial volatility. The Bank of Canada's recent $30 billion intervention in the repo market is a significant event that deserves attention. While the move was helped to stabilize the system in the short term, it also raises the important question about the health of Canada's financial system and the potential vulnerabilities that could be lurking beneath the surface. Is this a temporary liquidity issue, or is it a sign of deeper problems? Only time will tell, but one thing clear, the situation is worth monitoring closely in the months ahead. Canada's financial system may have been resilient in the past, but the global financial landscape is shifting, and it's more important than ever to stay informed. Thanks for watching. If you found this information valuable, don't forget to like and comment and subscribe to the channel. I'd love to hear what you think. Is this Bank of Canada making the right move?